quick note, this is for educational purposes only and not financial advice. Any decisions you make are your own responsibility, and trading involves risk. Most traders approach the markets backwards. They search for a strategy first, then try to force everything else around it. They look for entries, indicators, signals, something that tells them when to buy or sell. But that approach is fundamentally flawed because a trading system is not a strategy. A trading system is a complete decision-making framework that defines everything: what you trade, when you trade, how much you risk, and how you manage outcomes. And this is where most traders fail. Not because they lack intelligence, not because they lack effort, but because they never build a system. They collect ideas, they collect indicators, they collect fragments, but they never assemble those fragments into something structured, repeatable, and robust. So in this video, the goal is very clear. By the end of these sessions, you will understand how to build a trading system from first principles. Not copy one, not tweak someone else's approach, but construct your own system in a way that is logical, consistent, and aligned with how professional traders actually operate. Now, this is critical. A real trading system is not designed to win every trade. It is designed to survive, to produce consistent outcomes over time, and to function under pressure. That means it must be rules-based, it must be measurable, and it must be something you can execute without hesitation. You are going to learn how to define your edge, how to structure your process, how to integrate risk management properly, and how to ensure that your system works as a complete unit rather than a collection of disconnected ideas. Because once you understand this, everything changes. You stop guessing, you stop reacting, and you start operating with clarity and intent. Before building anything, you need to understand what a trading system actually is, because there is a misconception that a system is just a set of entry and exit rules, but that is only one small component. A true trading system is made up of 4 core pillars: market selection, strategy logic, risk management, and execution framework. And if even one of these is weak, the entire system becomes unstable. Market selection is about deciding what you trade and why. Not every market behaves the same way. Some are trend driven, some are range bound, some are highly sensitive to macroeconomic shifts. If you do not define your market focus, your results will always be inconsistent. Strategy logic is what most traders obsess over. This is your edge, the conditions under which you believe you have a statistical advantage. But here is where most traders get it wrong. They try to make their strategy perfect rather than making it robust. A professional system does not need perfection, it needs consistency. Risk management is the backbone. This is not an add-on. It is not something you think about after the fact. It is embedded into the system from the very beginning. Every trade, every decision, every outcome is shaped by how risk is controlled. And finally, execution framework. This is how you actually operate the system in real time. When do you trade? How do you handle losses? How do you respond to streaks? Without a clear execution framework, even the best strategy will fail. So understand this clearly. You are not building a strategy. You are building a system that integrates all 4 components into a single unified process. Now let's start from the foundation, market selection. Because this decision alone will determine a large part of your system's behavior. Most traders treat markets as interchangeable. They jump between instruments, chasing whatever looks active or exciting. But that approach destroys consistency, because each market has its own personality, its own drivers, and its own structure. A professional approach is different. You define your market universe deliberately. You choose instruments that align with your understanding, your time frame, and your ability to interpret information. For example, some traders focus on foreign exchange markets because they are heavily influenced by macroeconomic data and central bank policy. Others focus on indices where broader risk sentiment and capital flows dominate. Others specialize in commodities where supply and demand dynamics play a larger role. Now, this is where most traders get it wrong. They do not commit, they constantly switch, and as a result, they never build deep understanding in any one area. A strong trading system requires familiarity. You need to understand how your chosen markets behave under different conditions, how they respond to news, how they trend, how they consolidate. This familiarity is what allows your system to function effectively. So the first step in building your system is not finding an entry, it is deciding where you will operate, what markets you will focus on, and why those markets make sense for the type of trading you want to do. Because without that clarity, everything that follows becomes unstable. Once your market is defined, the next step is to build your strategy logic. This is where your edge begins to take shape. Now, this is critical. Your edge is not a single signal. It is a repeatable condition where the probabilities are slightly in your favor. That is all it needs to be. Not certainty, not perfection, just an advantage over time. But here is where most traders go wrong. They try to create overly complex strategies. They layer multiple indicators, filters, and confirmations, thinking that more complexity equals more accuracy. In reality, it often does the opposite. A strong strategy is simple but precise. It clearly defines what conditions must be present before a trade is considered. It removes ambiguity. It removes interpretation. For example, your logic might be based on trend continuation, mean reversion, or breakout conditions. But whatever it is, it must be clearly defined. You must know exactly what you are looking for and exactly what invalidates the setup. This is where discipline starts, because once the rules are defined, you are no longer free to improvise. You either follow the system or you do not. And this is what separates professional thinking from retail thinking. Retail traders look for reasons to enter. Professionals wait for their conditions to be met. So as you build your system, focus on clarity. Define your edge in a way that is simple, repeatable, and testable. Because if you cannot clearly explain your strategy logic, you cannot execute it consistently. Now we come to the most important part of the entire system, risk management. And this is not just important, this is everything. Because no matter how good your strategy is, you will have losing trades. That is unavoidable. The only question is how those losses are managed. Most traders treat risk as an afterthought. They focus on entries, they focus on profit potential, but they do not define how much they are willing to lose. And as a result, their outcomes become unpredictable. A professional system approaches this differently. Risk is defined first, not last, before a trade is even considered. The system already knows how much capital is at risk, where the trade is invalidated, and how that risk fits into the overall portfolio. This creates stability. It ensures that no single trade can cause significant damage. It allows the system to survive losing streaks, and most importantly, it creates consistency in outcomes. Now, this is where most traders get it wrong. They change their risk dynamically based on emotion. They increase size after wins. They decrease size after losses. They deviate from their rules, and this destroys the integrity of the system. A proper trading system removes that variability. Risk per trade is consistent. Position sizing is calculated. Losses are controlled, because the goal is not to win every trade. The goal is to ensure that when you lose small, and when you win, your system allows those wins to compound over time. And once this is properly integrated, your system stops being fragile and starts becoming something that can actually perform over the long term. Now that risk management is defined, the next layer is how your system handles trade management after entry. This is where many traders lose control, even if their entries are solid. Because entering a trade is only the beginning, what matters just as much is what happens next. How do you manage the position as it develops? Do you hold? Do you scale out? Do you adjust risk? Or do you interfere emotionally and disrupt the process? This is where most traders get it wrong. They have rules for entry, but no structure for what happens after. They start making decisions in real time based on fear, greed, or uncertainty. And that inconsistency destroys any edge they might have had. A professional system removes that uncertainty. It defines exactly how trades are managed from start to finish. This includes where profits are taken, how losses are handled if conditions change, and whether positions are adjusted or left untouched. Now, this is critical. Trade management must be consistent. It must not depend on how you feel in the moment. Because the moment you introduce emotional decision making, you break the system. Some systems are designed to let trades run fully to their target or stop. Others may include partial profit taking or trailing risk. The specific approach matters less than the consistency of its application. What matters is that once a trade is placed, the outcome is governed by rules, not emotions. That is what creates reliability. Because a trading system is not just about finding opportunities, it is about managing them correctly. And without structured trade management, even a strong strategy will fail over time. Now we move into something that most traders overlook entirely, defining the conditions under which your system should not trade. This is one of the most powerful elements of a professional trading system, knowing when not to act. Most traders feel the need to always be involved. They believe that more trades equal more opportunity, but in reality the opposite is often true. Overtrading is one of the fastest ways to destroy both capital and confidence. A strong system defines clear boundaries. It specifies when market conditions are unsuitable. This could be during low volatility environments, during highly unpredictable news-driven periods, or when the market structure does not align with your strategy logic. Now, this is where discipline becomes real, because these are the moments where there is temptation, the market is moving, there is activity, and yet your system says no. This is where most traders get it wrong. They override the system. They justify taking trades outside of their defined conditions. And over time, this erodes the entire framework. A professional trader does the opposite. They respect inactivity as part of the system. They understand that not trading is a decision, a strategic decision. So as you build your system, do not just define when you trade, define when you stand aside, because this is what protects your capital during unfavorable conditions and preserves your edge for when it matters most. At this point, your system is beginning to take shape. But now we need to address something deeper, how your system aligns with time. Time frame selection is not just a preference, it is a structural decision that impacts everything. Your strategy logic, your risk exposure, your psychological pressure, and your execution style. Most traders jump between time frames without understanding the consequences. They might analyze one time frame, enter on another, and manage the trade on a third. This creates confusion and inconsistency. A professional system is aligned. It operates within clearly defined time boundaries. You know exactly what time frame you analyze, what time frame you execute on, and how long trades are expected to last. Now this is critical. Your time frame must match your lifestyle and your psychological tolerance. Short-term trading requires constant attention, fast decision making, and the ability to handle rapid fluctuations. Longer term trading requires patience, conviction, and the ability to tolerate drawdowns over time. Neither is better. What matters is alignment. This is where most traders get it wrong. They choose a time frame based on perceived opportunity rather than personal compatibility, and as a result, they struggle to execute consistently. So when building your system, define your time frame clearly. Understand how often you will trade, how long positions will be held, and how that fits into your overall routine. Because a system that does not align with your time and attention will eventually break down. Now we come to one of the most misunderstood concepts in trading: consistency of execution. Most traders believe that consistency means winning regularly, but that is not what it means. Consistency means applying your system in the same way every single time. This is where most traders get it wrong. They treat each trade differently. They hesitate on some, rush others, adjust risk inconsistently, or override their rules based on recent outcomes. And this creates randomness. Even if the system has an edge, inconsistent execution removes it. A professional system is designed to eliminate this variability. The rules are clear, the process is defined, and execution becomes routine. Now this is critical. Your job as a trader is not to predict outcomes, it is to execute your system. The outcomes take care of themselves over a series of trades. This requires a shift in mindset. You stop focusing on individual trades and start focusing on the process. You measure success not by whether a trade wins or loses, but by whether you follow your system correctly. Because over time, if the system has an edge and you execute it consistently, the results will reflect that. But if you constantly interfere, second guess, or deviate, even the best system will fail. So as you build your system, understand this clearly. The system only works if you do. Now this is where everything starts to come together, because a trading system is not just built once and left unchanged. It is refined through structured feedback. Most traders either over-adjust or never adjust at all. They either change their system after every loss, or they refuse to evolve even when the system is clearly not performing. Both approaches are flawed. A professional system uses data. Every trade is recorded, every outcome is tracked, patterns are analyzed, not emotionally, but objectively. This is where journaling becomes essential, not as a casual habit, but as a core component of the system. You document your trades, your reasoning, your execution, and the outcome. Over time, this creates a data set, and that data set allows you to identify strengths, weaknesses, and areas for improvement. Now, this is critical. Adjustments to your system must be deliberate. They must be based on evidence, not emotion. If a pattern of weakness is identified, you refine the system. If the system is performing as expected, you leave it unchanged. This is how professional traders operate: continuous improvement, but with control and structure. Because the goal is not to constantly change your system. The goal is to evolve it carefully, ensuring that every adjustment strengthens the overall framework rather than destabilizing it. Now we move into something that separates amateur systems from professional ones: defining your edge with precision. Most traders say they have an edge, but if you ask them to explain it clearly, they struggle. They might describe indicators, patterns, or signals, but they cannot articulate why those things should produce a consistent advantage over time. This is where most traders get it wrong. They focus on what they see rather than why it works. A real edge is grounded in logic. It is based on an underlying reason why price is more likely to behave in a certain way under specific conditions. That reason might be rooted in market structure, behavioral psychology, liquidity dynamics, or macroeconomic forces. Now this is critical. If you do not understand the reason behind your edge, You will not trust it during difficult periods. And when you do not trust it, you will not execute it properly. A professional trader builds a system where the edge is clearly defined and logically sound. You know what conditions create the opportunity, you know why those conditions matter, and you know what invalidates that opportunity. This creates confidence, not emotional confidence, but structural confidence. Confidence that comes from understanding, because once you understand your edge at a deeper level, you stop questioning every outcome. You accept that losses are part of the process, and you continue to execute with discipline. Now let's address probability, because this is the foundation of everything your system is built upon. Trading is not about certainty. It is not about being right on every trade. It is about operating within a probabilistic framework where outcomes are uncertain in the short term, but predictable over the long term. This is where most traders get it wrong. They approach each trade as if it must work. They attach importance to individual outcomes, and when those outcomes do not go their way, they lose confidence. A professional system does the opposite. It treats each trade as one event within a large sample size. The focus is not on the individual trade, but on the distribution of outcomes over time. Now this is critical. Your system must be designed with this in mind. You must know your expected win rate, your average risk to reward ratio, and how those combine to produce a positive expectancy. Because without that understanding, you are operating blindly. You are hoping rather than executing. A strong system accepts uncertainty. It embraces the fact that losses will occur, and it is built in a way that those losses are controlled while gains are allowed to accumulate. This shift in thinking is fundamental, because once you start thinking in probabilities, you stop reacting emotionally to outcomes. You start focusing on execution and process, and that is what creates long-term consistency. Now, we need to go deeper into risk, because defining risk per trade is only the beginning. A professional system manages risk at multiple levels. Most traders think in isolation. They look at one trade at a time, but a professional system considers the entire portfolio. This means understanding how multiple positions interact, how correlated trades can increase overall exposure, and how risk accumulates across the system. Now, this is where most traders get it wrong. They take multiple trades that are effectively the same idea without realizing it. They believe they are diversified when in reality they are concentrated. A strong system controls this. It defines maximum exposure across related instruments. It ensures that risk is distributed appropriately, and it prevents overconcentration in a single theme. This is particularly important in markets where correlations are high, for example currencies, indices or commodities that move together under certain conditions. Now this is critical. Your system must have rules for total exposure, not just individual trades. It must define how much capital can be at risk at any given time. Because without this, even if each trade is managed correctly, the overall system can still become unstable. And this is where professional thinking comes in. You are not just managing trades, you are managing risk across a portfolio of decisions. Now let's address something that often gets ignored, the role of discipline within the system itself. Most traders think discipline is about willpower, about forcing yourself to follow rules, but a well-designed system reduces the need for willpower in the first place. This is where most traders get it wrong. They build systems that are too complex, too vague, or too demanding, and as a result they struggle to follow them consistently. A professional system is designed for execution. It is clear, structured, and realistic. It fits within your capabilities and your routine. Now this is critical. If your system requires constant monitoring, but you cannot realistically provide that attention, it will fail. If your rules are ambiguous, you will interpret them differently each time. So discipline is not just about behavior, it is about design. A well-constructed system guides your actions. It removes unnecessary decisions. It creates a clear path from analysis to execution. And this is what allows consistency to emerge naturally, not through force, but through structure. Because when the system is aligned with how you operate, discipline becomes easier. And when discipline becomes easier, consistency becomes possible. Now we come to something that ties everything together, defining your trading process from start to finish. A trading system is not just a set of rules, it is a sequence. A structured workflow that you follow every time you engage with the market. Most traders do not have this. They analyze randomly, they enter impulsively, and they manage trades inconsistently. There is no defined process. This is where most traders get it wrong. They focus on isolated actions rather than the entire sequence. A professional system defines each step, from initial market analysis to identifying potential setups, to validating those setups against your criteria, to executing the trade, and finally to managing and reviewing the outcome. Now this is critical. The process must be repeatable. It must be something you can follow consistently without deviation, because the process is what ensures that your system is applied correctly. It creates structure. It creates accountability. And over time, it allows you to refine your approach based on real data rather than random experience. So as you build your system, do not just think about individual components. Think about how they connect, how each step leads to the next. Because a trading system is not just what you do, it is how you do it every single time. Now we move into a concept that most traders never fully internalize: the difference between a system that looks good and a system that actually works. Many traders build systems that appear logical on the surface. The rules make sense, the structure seems coherent, and the entries feel convincing. But when applied over time, the results are inconsistent. This is where most traders get it wrong. They evaluate their system based on how it feels rather than how it performs. A professional system is validated through evidence, not assumptions, not opinions, but data. You need to see how your system behaves across a large number of trades under different market conditions. Now this is critical. 1 or 2 trades tell you nothing. Even 10 trades are not enough. You need a meaningful sample size to understand whether your edge is real. This is where testing comes in. Whether through historical analysis or forward execution, your system must be observed over time. You need to understand its strengths, its weaknesses, and how it performs in different environments, because every system has periods of performance and periods of drawdown. The goal is not to eliminate losses, but to ensure that the system remains profitable over the long term. And once you have that data, you stop guessing, you stop questioning every outcome. You trust the process because you have seen it work. Now let's go deeper into system robustness, because this is what determines whether your system survives real market conditions. A fragile system works only under specific conditions. It might perform well in trending markets, but fail completely in ranging environments. Or it might rely on very precise timing that is difficult to replicate consistently. This is where most traders get it wrong. They build systems that are too sensitive, too dependent on perfect conditions. A robust system is different. It performs reasonably well across a range of conditions. It does not need everything to align perfectly. It is designed to handle variability. Now this is critical. Markets are constantly changing. Volatility shifts, trends emerge and disappear, sentiment evolves. Your system must be able to operate within that uncertainty. This does not mean it will perform equally well at all times. There will be periods where it struggles, but it should not break down completely. A professional trader understands this. They do not expect perfection, they expect consistency over time. So as you build and refine your system, ask yourself this question: does it rely on ideal conditions, or can it function under pressure? Because the real test of a system is not how it performs when everything is perfect. It is how it behaves when conditions are less favorable. Now we need to address something that often undermines even well-built systems: over-optimization. This is one of the most common mistakes traders make, particularly when testing their systems. They adjust parameters, refine rules, and tweak conditions until the system performs perfectly on past data. And this is where most traders get it wrong. They confuse historical perfection with future performance. A system that is too finely tuned to past data often fails in live conditions because it has been designed to fit specific scenarios rather than general principles. Now this is critical. Your system should not aim to capture every possible opportunity. It should aim to capture a consistent type of opportunity. A professional system avoids excessive complexity. It focuses on core principles that are likely to persist over time. This is why simplicity matters, not because it is easier, but because it is more robust. Simple systems are less likely to break when conditions change. So when refining your system, be careful. Do not chase perfection. Do not adjust rules simply to improve past performance. Instead, focus on stability. Focus on whether the system makes sense logically and whether it can operate consistently across different conditions. Because the goal is not to build a system that looks perfect on paper. The goal is to build one that works in reality. Now let's talk about adaptability. Because while your system must be consistent, it must also be capable of evolving. Markets are dynamic. What works in one environment may not work in another. But this does not mean you should constantly change your system. This is where most traders get it wrong. They either refuse to adapt or they adapt too frequently. A professional approach is controlled adaptation. You monitor your system's performance over time. You identify whether changes in market conditions are impacting your results. And only when there is clear evidence do you consider adjustments. Now this is critical. Adaptation must be structured. It must be based on data, not emotion. For example, if your system consistently underperforms in certain conditions, you may refine your rules to avoid those environments, or you may introduce a filter that improves performance. But these changes are deliberate. They are tested. They are integrated carefully because every change has consequences. And if you adjust too frequently, you lose the stability of your system. So the goal is balance, consistency in execution, combined with measured, evidence-based evolution. That is how a professional system remains effective over time. Now we reach a point where your system is fully structured, but there is one final layer that determines whether it will actually succeed, minus your ability to trust it. Trust in your system is not something you can force. It comes from understanding, from testing, and from experience. This is where most traders get it wrong. They build a system, but they do not fully believe in it. So when losses occur, they hesitate, they override rules, they abandon the process. A professional trader does the opposite. They trust their system because they have validated it. They understand its behavior. They know what to expect over time. Now this is critical. Trust does not mean blind faith. It means informed confidence. You know that the system will produce losses. You know that there will be drawdowns. But you also know that, over time, it produces positive results. And that allows you to execute without hesitation. Because at the end of the day, a trading system is only as effective as your ability to follow it. You can have the best system in the world, but if you cannot trust it, you will never execute it properly. And if you cannot execute it properly, it will never deliver the results it is capable of producing. Now we move into a level of thinking that separates professional traders from everyone else: decision frameworks. At this stage, your system is built, it has structure, logic, and defined rules. But what elevates it further is how decisions are made within that structure. Most traders think in terms of individual trades. Should I enter? Should I exit? Should I adjust? These are isolated decisions, often made under pressure. This is where most traders get it wrong. They rely on instinct in the moment rather than a predefined framework. A professional trader operates differently. Every decision is mapped to a framework. That means there is a clear logic behind every action, and that logic is consistent across all situations. Now, this is critical. A framework simplifies complexity. It allows you to process information quickly without becoming overwhelmed. For example, instead of reacting emotionally to market movement, you are simply checking whether conditions align with your predefined criteria. If they do, you act. If they do not, you wait. This removes hesitation, it removes doubt, and it ensures that every decision is aligned with your system. Because in reality, successful trading is not about making brilliant decisions. It is about making consistent decisions. And that consistency comes from having a clear framework that governs how you think and act in every situation. Now let's go deeper into how professional traders view opportunity, because this is often misunderstood. Most traders see opportunity everywhere. Every movement looks like a potential trade. Every fluctuation feels like something that must be acted upon. This is where most traders get it wrong. They confuse activity with opportunity. A professional trader sees things differently. Opportunity is rare. It only exists when specific conditions align with the system's edge. Now, this is critical. Not every market movement is meaningful. Not every setup is valid. Your system is designed to identify a very specific type of opportunity, and anything outside of that is irrelevant. This is why patience becomes a strategic advantage. You are not trying to trade more, you are trying to trade better. A professional system filters out noise. It ignores everything that does not meet the criteria, and it focuses only on high quality opportunities. Because over time, it is not the number of trades that determines success, it is the quality of those trades. And once you internalize this, your entire approach changes. You stop chasing the market, you stop forcing trades, you wait, and when the right conditions appear, you act with confidence. Now we need to address something that is rarely discussed but absolutely essential: how professionals handle uncertainty. Uncertainty is constant in trading. You never have complete information. You never know exactly what will happen next. Most traders struggle with this. They try to eliminate uncertainty. They look for confirmation, for certainty, for something that guarantees the outcome. This is where most traders get it wrong. They are uncomfortable with not knowing. A professional trader accepts uncertainty completely. It is built into the system. It is expected. Now, this is critical. Your system does not remove uncertainty, it manages it. You define your edge, you control your risk, and you execute consistently. Beyond that, the outcome is uncertain, and that is acceptable because over a large number of trades, the probabilities play out. But in the short term, anything can happen. This is why emotional control is so important. Not because emotions are bad, but because reacting to uncertainty disrupts the system. A professional system allows you to operate despite uncertainty. It gives you structure in an unpredictable environment. And once you accept that uncertainty is part of the process, you stop fighting it, you start working with it. Now let's look at how professionals think about losses, because this is another major point of separation. Most traders see losses as failure, something to avoid, something to minimize at all costs. This is where most traders get it wrong. They take losses personally. They see them as a reflection of their ability. A professional trader sees losses differently. Losses are simply part of the system. Now, this is critical. A losing trade does not mean the system is broken. It means the probabilities did not play out in that instance. As long as the trade was executed according to the system, it is considered a successful execution, regardless of the outcome. This is a fundamental shift in thinking, because once you stop judging trades based on outcome, you can focus on what actually matters, process. A professional system expects losses. It is designed to handle them. It ensures they are controlled, consistent, and manageable. And because of that, losses no longer disrupt the system. They are absorbed as part of the overall distribution of outcomes. This is what allows long-term consistency, not avoiding losses, but managing them correctly. Now we come to one of the most powerful concepts in professional trading, thinking in terms of sequences, not individual trades. Most traders focus on the next trade. They want it to win. They want immediate validation. This is where most traders get it wrong. They attach too much importance to single outcomes. A professional trader thinks in sequences, groups of trades, series of outcomes. Now this is critical. Your system's edge only becomes visible over a sequence of trades. Not one, not two, but many. This means that any individual trade is insignificant. It is just one data point within a larger distribution, and this changes everything. Because once you think this way, you stop reacting emotionally to individual results. You stop adjusting your system based on short-term outcomes. You focus on executing consistently over time. A professional system is designed for the long term. It is built to perform across sequences, not isolated events. And once you internalize this, your mindset shifts completely. You become less reactive, more disciplined, and far more aligned with how real trading success is achieved. Now we move into practical application, because at this stage your system must transition from theory into real execution. This is where most traders get it wrong. They build a system that makes sense on paper, but when it comes to actually using it, they hesitate, they overthink, or they abandon it altogether. So the key question becomes this: how do you actually operate your system in real time? A professional approach is structured and deliberate. You begin each session with a clear routine. You review your chosen markets. You assess whether conditions align with your system, and you identify whether any valid opportunities exist. Now this is critical. You are not searching for trades, you are checking for alignment. If the conditions are not present, you do nothing. If they are present, you move to the next step. You validate the setup against your defined rules. Every condition must be met. No exceptions, no interpretation. Once validated, execution becomes straightforward. The trade is placed according to your predefined risk parameters. There is no hesitation because the decision has already been made by the system, and from that point, management follows your rules, not your emotions. This is how a professional system operates: structured, consistent, and controlled. Because when you remove randomness from your process, execution becomes something you can rely on. And now let's go deeper into daily and weekly structure. Because consistency in trading is built through routine. Most traders operate randomly. They check the markets at different times, they analyze inconsistently, and they take trades without a defined schedule. This is where most traders get it wrong. They treat trading as reactive rather than structured. A professional system is embedded into a routine. There are defined times for analysis, defined times for execution, and defined times for review. Now this is critical. Routine creates stability. It ensures that your system is applied in the same way every day. For example, you might begin each week by reviewing broader market conditions, identifying the key themes, the dominant drivers, and the environments where your system is most likely to perform. Then on a daily basis, you assess whether those conditions are still valid You look for setups that align with your system, and you execute only when everything is in place. At the end of each day or week, you review your trades, not just the outcomes, but the execution. Did you follow your system? Were there deviations? What can be improved? This cycle, analyze, execute, review, is what creates consistency over time, because a trading system is not just something you use occasionally. It is something you integrate into a structured process. Now we need to address one of the most important aspects of real-world trading, handling pressure. Because no matter how well your system is designed, there will be moments where it is tested. You will experience losing streaks. You will face uncertainty. You will question whether the system is still working. This is where most traders get it wrong. They abandon their system during these periods. They start making impulsive decisions, trying to recover losses or avoid further pain. A professional trader does the opposite. They rely on the system even more during difficult periods. Now this is critical. Your system is designed to handle variability. Losing streaks are part of that. They are expected. The key is to remain consistent, to continue executing according to your rules, even when results are not immediately favorable. This requires discipline, but more importantly, it requires preparation. You must understand your system's behavior in advance. You must know what drawdowns are normal, because when you expect these periods, they no longer feel like failure. They feel like part of the process. And that allows you to stay aligned with your system rather than reacting emotionally. Now we bring everything together. Building a trading system from scratch is not about finding a perfect strategy. It is about constructing a complete framework that allows you to operate consistently in an uncertain environment. You have learned how to define your market, how to build your strategy logic, how to integrate risk management, and how to structure your execution. You have understood the importance of consistency, probability, and process. And you have seen how professional traders think in terms of frameworks, sequences, and long-term outcomes. Now this is critical. None of this works in isolation. A trading system is only effective when all components are aligned. Your strategy must fit your market. Your risk management must support your strategy. Your execution must follow your rules. And your mindset must support the entire process. Because trading success does not come from one element. It comes from the integration of all elements into a single cohesive system. And once that system is built, your role becomes clear, you execute. So here is the final perspective. What it really takes to build a trading system is not intelligence or talent or even experience in isolation. It is structure, discipline, and consistency. Most traders spend years searching for something external, a better indicator, a better strategy, a better signal. But the reality is the edge comes from how everything is put together. A well-constructed system removes uncertainty from decision making. It creates clarity, it creates consistency, and it allows you to operate with confidence even in unpredictable markets. Now this is where everything changes, because once you have a system, you are no longer reacting to the market. You are operating within a defined framework. You are no longer guessing, you are executing. And over time, that consistency compounds. It builds results, it builds confidence, and it builds the foundation for long-term success. So the focus now is simple. Build your system, refine it, trust it, and execute it with discipline. And if you do that consistently, you move from being someone who trades to someone who operates like a professional. If you found this valuable, make sure to like, comment, share, and subscribe and stay consistent, because that is where real results are built.